The idea was simple. Once boomers started passing down their wealth, young adults would finally get their shot at homeownership. But in 2025, the numbers tell a different story. The homeownership rate for people under 35 has dropped to 36.6%, the lowest it's been in 6 years. Meanwhile, the median age for first-time buyers keeps rising, and home prices have climbed 27% since 2020. Inherited homes aren't flooding the market either. Most end up as rentals or vacation properties, not opportunities for new buyers. I'm going to show you why this so-called wealth transfer never reshaped housing and what you need to watch out for. The Great Wealth Transfer Myth. The idea behind the Great Wealth Transfer was straightforward. As baby boomers aged and passed on their assets, younger generations would finally get access to affordable homes. Economists and policymakers expected a wave of new listings, unlocking opportunities for first-time buyers. But the reality in 2025 is far from that prediction. Instead of a flood, there's been a trickle, and the doors to homeownership remain firmly closed for many. A closer look at the numbers reveals why. A significant share of inherited homes never even reach the open market. Many heirs choose to hold on to these properties, converting them into rentals or vacation homes rather than selling. This decision is often driven by the prospect of steady rental income or the desire to maintain a family legacy. As a result, the supply of homes available to younger buyers stays limited, and the market remains tight. Timing plays a crucial role as well. Most people inherit property much later in life than expected. The median age for receiving a home inheritance has climbed to 42. By that point, many recipients have already established their own households, either renting or buying a smaller property elsewhere. For them, the inherited home is less a lifeline and more an additional asset, something to supplement their wealth, not a first step into homeownership. When inherited homes do go up for sale, the buyers are rarely first-timers. The majority of these properties are sold to existing homeowners, often those looking to expand their portfolios or move up the property ladder. First-time buyers remain a small fraction of these transactions, squeezed out by cash offers and higher borrowing power. The transfer of wealth, rather than opening up the market, simply circulates homes among those who already have real estate holdings. Location is another major factor. Most boomer-owned homes are in suburban neighborhoods built decades ago, often far from city centers, amenities, or the kinds of jobs that attract younger buyers. A recent analysis found that only a small portion of inherited homes are located in areas considered desirable by Millennials and Gen Z. The rest are in regions with aging infrastructure and declining school districts, making them less attractive as starter homes. Tax incentives further complicate the picture. Current policies, such as the stepped-up basis rule, allow heirs to avoid capital gains taxes if they keep inherited properties. This encourages families to hold on to homes rather than list them. Other tax mechanisms, like 1031 exchanges, make it easier for property owners to swap one investment property for another without triggering a tax bill, reinforcing the tendency to keep homes in the family or as rentals. The rise of accidental landlords has become a defining trend. Many heirs, uninterested in living in the inherited property, choose to rent it out instead. Property management firms report a surge in clients who have inherited homes but lack the desire or expertise to manage them. This shift has led to a growing pool of rental properties, but not necessarily to better housing options for tenants or would-be buyers. Debt is another hidden obstacle. A significant number of inherited properties come with mortgages, liens, or other financial encumbrances. Many heirs are forced to sell quickly just to clear outstanding debts, and these rushed sales often go to institutional investors who can pay cash and close fast. This process further concentrates housing wealth in the hands of those already well-positioned in the market. The expectation that downsizing boomers would free up starter homes hasn't played out either. Most older homeowners are staying put or moving into high-end senior communities, not releasing affordable homes back into the market. The few who do sell often accept offers from buyers with the most cash on hand, leaving younger, less wealthy buyers at a disadvantage. The result is a housing landscape divided by inheritance and access. Families able to pass down property build lasting wealth, while those without that advantage face even greater barriers. The gap between owners and non-owners has only widened. And as the wealth transfer myth fades, another force has stepped in to shape the market, one that affects every buyer, regardless of age or inheritance. Mortgage rates in 2025, the new normal. Mortgage rates are now the defining factor in the 2025 housing market. The average 30-year fixed rate sits at 6.67%, a level that would have seemed unthinkable just a few years ago. What was once dismissed as a temporary spike has become the new baseline, and the effects are everywhere. For most buyers, especially those entering the market for the first time, the numbers just don't add up. Home prices have not dropped enough to compensate for the higher cost of borrowing, and wages have failed to keep pace. The result is that the average household must now commit 42% of its income to afford the median-priced home, a burden not seen since the 1980s. Consider a typical scenario. A $400,000 mortgage at today's rates requires a monthly payment of about $2,450 before taxes and insurance. To stay within recommended debt-to-income ratios, that means an annual household income of nearly $100,000. But the median income for buyers under 35 is only $72,000. Even with a 10% down payment, now nearly $50,000, monthly payments are $800 higher than they would have been just a few years ago. This gap has created a generation of renters who technically qualify for mortgages, but would have to devote almost all their disposable income just to own. Lenders have responded by tightening their requirements. Higher credit scores and larger down payments are now standard, with the average approved FICO score for conventional loans reaching 753, up significantly from pre-pandemic levels. First-time buyers putting down less than 20% face additional costs, as private mortgage insurance premiums have jumped 35% since 2022. That adds another $200 per month for a typical loan, putting ownership even further out of reach for those without family assistance or existing assets. The Federal Reserve's policy choices continue to weigh heavily on the market. As the Fed lets billions in mortgage-backed securities roll off its balance sheet each month, a major source of liquidity has disappeared. Institutional buyers have moved in to fill the gap, now making up nearly a third of new mortgage originations. These investors can accept thinner margins and offer more aggressive terms to wealthy clients, while individual buyers find themselves pushed further down the list. Regional differences make the situation even more complicated. In cities like Austin and Boise, pandemic-era price surges combined with higher rates have slashed purchasing power by more than half. A household that once qualified for a $500,000 mortgage at 3% now only qualifies for $320,000. Meanwhile, buyers in high-cost markets like New York or San Francisco face effective rates well above the national average, especially for larger loans. The national numbers can be misleading, masking just how severe the affordability crisis has become in certain areas. Refinancing has nearly vanished, with only 3% of outstanding mortgages refinanced last year compared to 15% during the 2020 boom. Most homeowners locked in sub-4% rates and have no reason to move or sell. This has frozen inventory, with existing homes staying off the market and new construction focused on luxury units. Starter homes make up just 18% of new builds, less than half the share from the 1980s. Since building for wealthier buyers makes more sense when financing costs are high, renters are caught in a parallel trap. Average rents have risen 31% since 2020, leaving the typical tenant spending over a third of their income on housing. Saving for a down payment has become nearly impossible, and high rent payments are now seen as a risk factor by lenders. In some cities, renting a modest apartment costs almost as much as a mortgage, but the barriers to ownership remain insurmountable. Inheritance has not provided much relief. Heirs often can't qualify for loans to renovate or maintain inherited homes. So many are forced to sell quickly to investors. This accelerates wealth concentration, as more properties end up in the hands of institutional buyers instead of families. Programs meant to help first-time buyers have failed to keep up. Income limits and down payment assistance amounts are out of step with today's prices. And even targeted programs for teachers or first responders do little to reduce monthly payments at current rates. The systems designed to promote ownership now serve mainly those already close to qualifying. Mortgage rates have not just changed the math, they have changed the entire structure of the market. The biggest obstacle for buyers is no longer just the price of a home or the size of a down payment. The real challenge is that so many homes never even reach the market at all. The boomer retention problem. A major force shaping today's housing market is the decision by baby boomers to remain in their homes well past retirement. This isn't just a matter of personal preference. It's a structural shift with far-reaching consequences for everyone trying to buy. In 2025, the proportion of boomers aging in place has reached an all-time high. Compared to previous generations, far fewer are downsizing or moving to retirement communities. Instead, they're holding on to the same homes they've lived in for decades, creating a bottleneck in the supply of available properties. Several factors drive this retention problem. For many boomers, the financial logic is straightforward. Nearly 60% of them have mortgages with rates below 4%, often locked in during the low-rate era of the early 2020s. Trading that for a new loan at today's much higher rates would mean hundreds or even thousands more in monthly payments, an expense that doesn't make sense for retirees living on fixed incomes. Even those who own their homes outright face financial disincentives to move. In states with property tax freezes for older residents, selling and relocating could mean losing those protections and facing dramatically higher tax bills. Physical and emotional barriers also play a major role. Most boomer-owned homes were never designed with aging in mind. Only a small fraction have accessibility features like step-free entries or single-level living. Retrofitting these homes is expensive, but so is moving into assisted living, costs that now exceed $75,000 a year in many places. Instead, families often opt for smaller-scale home modifications and piecemeal in-home care, patching together solutions that allow seniors to stay put. This keeps homes off the market for longer than any previous generation. The emotional attachment to their homes cannot be underestimated. Many boomers see their homes as the place where their lives have unfolded, filled with decades of memories. This sentimentality makes leaving difficult, even if the home no longer fits their needs. In many suburban neighborhoods built in the 1970s and 1980s, residents have now lived in the same house for 25 years or more. These communities have become stable enclaves, with turnover rates at historic lows and little incentive for owners to sell. The effects ripple outward. The homes that boomers hold onto are often the very properties that would have served as starter homes for younger families. Instead, these houses remain occupied, reducing housing turnover and limiting the options for people trying to enter the market. In 1990, seniors made up about a quarter of owner-occupied households. Now that share has climbed above a third, shifting the demographic makeup of entire neighborhoods and school districts. When these homes do eventually change hands, it's often not through a sale on the open market. Increasingly, heirs inherit the properties and choose to hold on to them as rental units or vacation homes. This trend has created a growing stock of single-family rentals scattered across suburbs, homes that would otherwise be available for purchase. Property management companies have made it easier than ever for inheritors to keep these homes as investment properties, further reducing the number of listings for first-time buyers. Municipalities are feeling the pressure as well. Aging in-place concentrations put new demands on local services, from emergency medical calls to infrastructure maintenance. At the same time, school enrollment drops as fewer young families move in, but the need to maintain schools and other public facilities remains. The fiscal burden shifts toward younger residents, who face higher taxes and fewer public resources. Advances in medical technology and in-home care have only deepened the retention problem. Telehealth, remote monitoring, and home-based healthcare have made it possible for seniors to manage complex medical needs without leaving their homes. These improvements extend the time boomers can stay put, delaying the point at which homes return to the market. The result is a housing market where the usual cycle of turnover has stalled. For would-be buyers, especially younger ones, the scarcity of available homes is only part of the challenge. Even when a property does come up for sale, the hurdles to ownership have grown higher than ever. Down payment realities. Down payments now define the reality of buying a home in 2025. The average first-time buyer must bring 12% to the table, nearly double what was required just a few years ago. For the median-priced home, at $416,900, that's $50,028 in cash up front. For a typical 30-year-old earning $72,000 a year, saving that amount under current conditions takes nearly 9 years. And the target keeps moving. Home prices have risen 27% since 2020, and while buyers are saving, the cost of entry keeps climbing. The longer it takes to save, the further out of reach the goal becomes. Lenders are not easing the path. Since the sharp corrections in some markets after 2023, banks have tightened standards, treating large down payments as a buffer against volatility. Any conventional loan application with less than 10% down now triggers additional scrutiny. This shift has cut approval rates for first-time buyers by more than 20% compared to repeat buyers with similar credit. Automated underwriting systems are programmed to flag low down payments as higher risk, creating a cycle where fewer approvals reinforce even stricter standards. The generational divide is clear. Older millennials, now in their late 30s and early 40s, managed average down payments of 13% in 2025, while younger buyers put down only 10%. This difference tracks with career stage and income, but even for those at their earning peak, the financial strain is obvious. Surveys show 38% of young buyers now name down payment savings as their biggest obstacle, a sharp rise from previous years. It's not a matter of poor saving habits. Home prices are simply outpacing what most people can reasonably set aside. Government support hasn't bridged the gap. While some programs in Canada have raised insured mortgage limits, U.S. assistance remains capped by conventional loan limits. In high-cost cities like Los Angeles, a starter home often exceeds these caps, forcing buyers to either bring much more cash or turn to riskier loans. State-level aid rarely covers even half the required down payment. These shortfalls mean that buyers in expensive markets face the steepest barriers, with few viable workarounds. The math behind saving is relentless. Even if a household could save $800 a month after rent and expenses, a stretch for most, the process would take over 5 years, during which time both rents and home prices continue to rise. Many buyers report cutting back on essentials, delaying healthcare, or taking on second jobs just to scrape together enough for a down payment. In 2025, nearly 7 out of 10 successful first-time buyers reported making significant financial sacrifices to reach the starting line. Those who already own homes play by different rules. The average down payment for repeat buyers sits at 19%, but the important detail is that most leverage equity from their previous homes. Selling a property with built-up equity allows these buyers to make large down payments on more expensive homes, reinforcing a cycle where existing owners move up while newcomers face steeper odds. Renters, by contrast, start from scratch and compete with buyers who have a head start. Regional differences make the challenge even more pronounced. In cities like Seattle, the median home price now demands a down payment that exceeds the annual income of most local renters. Even for dual-income households saving aggressively, the timeline to reach that target stretches into nearly a decade. In other markets, private mortgage insurance costs eat away at any advantage of a smaller down payment, adding hundreds to monthly payments and pushing ownership further out of reach. The way down payments are treated by lenders also shapes outcomes. Automated systems often favor buyers who can show a lump sum, even if it comes from a parental gift, over those who have steadily saved while paying high rents. Loans from retirement accounts count against debt-to-income ratios, while family gifts do not, further skewing the process toward those with existing wealth. The psychological effect is hard to ignore. Most millennials haven't even started saving for a down payment. Not because they're unwilling, but because the numbers don't add up. When the path to ownership looks impossible, many simply opt out. The down payment has become more than a financial hurdle. It now serves as a dividing line, shaping who gets to build wealth through real estate and who is left waiting for a break that may never come. The inheritance lottery. For those hoping a family windfall would finally unlock the door to homeownership, the reality of the inheritance lottery is far less promising. In 2025, only a small fraction of millennials and Gen Z report receiving any property from relatives. Even when inheritances do occur, the benefits are concentrated among families who are already well off. The anticipated broad transfer of wealth has instead become a mechanism for reinforcing existing financial divides. Inherited properties often fail to deliver the advantages younger generations need. Many of these homes are located in areas with stagnant job growth or limited amenities, places that don't match where most young adults want or need to live. When inheritors receive a home in a declining region, they face tough decisions. Hold on to a property that may lose value or sell quickly, often to investors at a discount. The chance to use an inheritance as a springboard into a desirable market is rare. For most, the windfall is either an anchor or a fleeting opportunity, not a solution to the housing dilemma. A growing share of inherited homes never reach the open market. In 2025, 65% of inherited properties kept within families are converted into rentals, the highest rate ever recorded. This shift is rarely a matter of choice. Many heirs become landlords by default, lacking the resources or desire to occupy or renovate the property. The rental income often barely covers upkeep and taxes, but the alternative, selling, can trigger tax consequences or family disputes. As more inherited homes become rentals, the supply of homes available to first-time buyers shrinks further, intensifying competition and driving up rents. Vacation homes are another outcome. About 35% of inherited primary residences are now held as second homes or seasonal properties, especially in regions with tax advantages. These homes sit empty for much of the year, removing them from the local housing pool and contributing to affordability problems in both tourist destinations and quiet suburbs. This ghost inventory accumulates, making it harder for new families to find homes in areas with already limited supply. The timing of inheritance rarely aligns with financial readiness. Student debt remains a significant burden, with 2025 graduates carrying an average of $32,000 in loans. For many, the window when an inheritance might help with buying a home closes before they can realistically qualify for a mortgage. Lenders routinely deny applications from heirs who lack the income or credit profile to take on additional debt, forcing rapid sales to institutional buyers. These transactions rarely result in the kind of wealth building that inheritance was supposed to provide. Tax policy and family structure further complicate the picture. Couples inheriting property can avoid capital gains taxes under current rules, but single heirs or groups of siblings often face logistical and financial obstacles. Disagreements over what to do with the property can lead to quick sales at below-market prices. Meanwhile, the wealthiest families use estate planning tools to keep homes in trusts for decades, locking up assets and ensuring their children maintain a real estate advantage long into the future. For most, however, the process is marked by uncertainty and limited options. Banking requirements add another layer of difficulty. Mortgages on inherited homes often require substantial cash reserves, a hurdle that only a minority of heirs can clear without liquidating other assets. Private wealth clients, by contrast, can access favorable loan terms using investment accounts as collateral, further deepening the gap between those with generational wealth and those without. Even when inheritors want to use the property, practical barriers remain. Many inherited homes need significant repairs, on average, $28,000 worth, before they can be lived in or rented. Infrastructure limitations like poor broadband access or outdated utilities make some properties all but unusable for modern work or family life. The asset on paper becomes a liability in practice. The promise of inheritance as a great equalizer has faded. Instead, the process has become another filter, sorting those who already have resources from those who do not. And as more heirs look for quick solutions, a new set of buyers has emerged. Ones who are ready to move before a home ever reaches the public market.